You're watching episode 56 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to today's episode of the Tax Smart Daily. I'm Brandon Hall, a CPA and founder of the Real Estate CPA. And before we get started, I invite you to join our Tax Smart Facebook group. The link to that group is below. We're having a lot of really fun conversations about how landlords can be more tax efficient and what things that you should be making your CPA aware of. So a question coming out of that Facebook group is, if I don't qualify as a real estate professional and I can't use my passive losses, why should I even invest in real estate? Are there really even tax advantages for me? And the answer is, of course, yes. Now, when I'm explaining this, I always like to go back to the Warren Buffett story about how he said that his secretary pays more taxes than he does. And that's not totally true. Warren Buffett pays millions of dollars in taxes every year. His secretary does not. But Warren Buffett pays a lower tax rate compared to his total income than his secretary pays compared to her total income. So for example, let's say that you earn in $100,000 and you pay a $30,000 tax. Your rate is 30%, and we call that your effective tax rate, the total tax divided by the total amount of income that you earn. But if you can grow that income from $100,000 to $200,000, and if you can keep that $30,000 tax the exact same, now you're paying $30,000 on $200,000 of income. And $30,000 divided by $200,000 is 15%. So you've lowered your effective tax rate by increasing income. And the whole thing here is that the only way that I can increase my income from 100 to 200 without increasing my tax is I've got to create tax advantageous cash flow. And that's exactly what real estate does for us. So if I buy a rental property for $100,000, I can't depreciate land. So we always have to value the building and the land differently. So maybe the land is worth $10,000. And we have some other episodes on how to do that specifically, and I'm not going to dive into it today. So the land's worth $10,000, my building's worth $90,000. I depreciate my $90,000 building over 27 and a half years, and that's going to equal about $3,200 of depreciation expense every single year. And depreciation is meant to track the deterioration of my asset over time. So even though real estate appreciates in value, what's really happening is the building is wearing down over time. It's falling apart. And that's what depreciation is tracking. So even though my asset value goes up, depreciation is the annual expense, the annual benefit that the government grants me because I own a building that's falling apart. So let's say that I cash flow $3,000 during the year. That's my rental income minus all my expenses, minus my mortgage payments and all of that jazz. I cash flow about $3,000 during the year. If my depreciation is $3,200, then I actually have a $200 tax loss. Now it's not going to work out exactly like that because you can't deduct your mortgage payments in this calculation, but just go with it. So I've got $3,000 of net taxable, I've got $3,000 of income, and then I have my depreciation expense of $3,200 every single year for 27 and a half years. And so I have a $200 tax loss, even though $3,000 actually hit my pocket. That's cold hard cash that I have pocketed that I can now use, but I'm telling the IRS that I lost $200 thanks to depreciation, and that is a tax loss. So that $200 is a tax loss, and then I have to apply the passive activity rules to figure out if I can use the tax loss or if I can't use the tax loss. And that's beyond the scope of today's video. The point is that I have $3,000 of income that I have earned that's actually hit my pocket, but I told the IRS that I lost money. So what I've done is I've created a $3,000 income stream that I'm not paying tax on today. And if I can do that 10 times, that's $30,000 of income that I'm receiving today, and I'm reporting a $2,000 tax loss to the IRS each year. So if I earn $100,000 and I'm paying $30,000 on that income, and let's say that $100,000 is my W-2 income, my effective tax rate is 30%. But if I buy 10 rental properties and they all cash flow $3,000 a year, and my depreciation expense is $3,200 a year for all of those properties, then I'm really going to increase my income from $100,000 to $130,000, and I'm still going to have that same $30,000 of tax because the additional $30,000 of income that I've created by buying 10 rental properties that each cash flow $3,000, but I don't pay tax on, that $30,000 is not taxable to me today. And if you take $30,000 and you divide that by $130,000, you'll see that you get an effective tax rate of 23%. So I've reduced my effective tax rate by 7% by adding $30,000 of income from rental properties that's not taxed today. That, my friends, is the power of investing in real estate. Thanks so much for watching today's episode of the Tax Smart Daily. I hope you enjoyed it. If you have any questions or if anything that I say resonated with you, drop me a comment below. I love engaging with our community. And check out all of our social media links. Follow us online. We'd love to have you be a part of our larger community.